How y'all doing? Welcome back, AMC family. Hey, it's Planet of the Apes, all right? What's up, players, traders, and haters? It's your boy D. This is D's Daily DD. And I've had some time to cool my head, calm down, kind of react to this information. The major information that we got today for Ape was the FTD report and the 43 million FTDs that occurred on a single day, which was on August 24th, 2 days after the Ape dividend was released. Now, I have a lot of information to bring to y'all. I kind of gave you my thoughts and opinions, on the first video I just released a couple, like an hour ago, an hour and a half ago. And so I wanted to kind of give you some insight in what's going on and what I see going on in the background and with the transactions and kind of like who the role players are. And remember, this is not financial advice. Never take it for financial advice. Take it for educational, entertainment purposes only. I always bring the receipts, all right? And I got them today too. So I took the time, right? There's gonna be a two-part video. This is gonna be part one where we're gonna cover about half the document. And then tomorrow I will cover the rest of the document. And the video, the lighting I could tell looks a little bit different, a little bit lighter. I don't usually record this late in the day, but I'm here. I gotta get this information out to y'all. So if you can, sorry, I just had lunch too. Or like an early dinner. So subscribe, hit that like button for me, share the information with the apes, whoever needs to hear this. And if you're not for AMC and ape, I mean, then you don't need to watch this video, all right? But yeah, I want to bring this, even though there should be, educational purposes, because a lot of this stuff will have to do with the overall market as well, not just ape and AMC. So we're going to get into the information, all right, guys? Let's do it. All right, first off, I'm gonna start talking about the basics real quick with what naked shorting is and with what traditional shorting is. I have something that I wrote out, I drew it out, but let's just first jump into this and look at this. This is the proof, all right, that we were seeing with Ape. The report came out today, and on the 24th, there was 43 million shares that were considered FTDs. And I'm gonna explain to you guys, how this kind of happens from the research that I've done. But remember, please don't make any financial decisions based on my content, especially with this video, okay? But yeah, it's amazing. And yeah, they got it down to 5.6 million somehow. I don't know how. I mean, there's no options chain, so that's what's interesting to me. That's why we have to do research to kind of understand where we're at. But that's the big news, right? The 43 million. And it was just perfect because when that information came out, I was already working on this information and it just pretty much lined up. And now I think it will help a lot of people. So let's, oops, that's the second one that I need to show y'all. This should be the first one. Okay. Yeah, and I'm getting all that information from that document, right? That's the receipt. But what we got here, we got two columns, and I'm gonna break down shorting because I think people are still confused on what shorting is and how it occurs and what is supposed to happen. So the first thing we want to look at is going to be here. So the SEC is supposed to be overlooking the DTCC, right? That's their job. And then the DTCC has subsidiaries like the DTC and the NSCC. All right. So you got to understand these three, maybe these four entities here for sure. They're the ones who handle a lot of what happens with the transactions and the settlements. So let's break it down with shorting. First off, basically when they do this, it's a zero fee, zero rebates when it comes to naked shorting. And these are like the differences or how they're the same and different, right? So let's go down the list. So the first one, selling stock, you're still selling stock, and whether it's the naked way or the traditional way, you're selling stock, which adds selling pressure to the stock price. Although when you naked short sell, you do not locate the actual share. When it comes to traditional short selling, you do locate from a broker or an institutional lender. That's why they're called naked, because you don't have the actual share. All right. There's no borrow fee because you're not actually borrowing the share. It has been known to be abusive and manipulative in stocks. Many cases have arisen, right, with naked short selling throughout time. And AMC, in my opinion, right now is right now involved in something that's going on like this in the background. I don't have proof though. All right. So don't think that it's, certain. I'm just giving you information on what this is. So they both apply selling pressure to the stock, right? Some naked shorting is due to market making because of the T+2. Because when you are a market maker, you're supposed to provide liquidity, and that's where the issues come in, where if it becomes abusive. And then you know, over here, when you do it the right way, if you're a short seller and you borrow from an institution or a lender, the seller is supposed to leave the proceeds with the lender plus a little more. So that's like the incentive to do it, to short. All right. Because why would you lend out your shares? Because you need to get something in return, right? If you're the lender. Now, market making, I guess, you know, like I said, T+2, or it used to be T+3, you know, I think now it's T+2. But basically, you know, they have to settle and locate those shares within 2 days is what it's supposed to happen. But the lender, right, when they receive this cash from whoever is borrowing the shares, they can invest that collateral. They can use that money to try to make money while the share is on loan. So that's why this gets very complicated. That's why this gets very intertwined and confusing. Then it's if it's difficult or impossible to borrow the stock, that's when, you know, whoever's doing it, whoever has done it, or whoever naked shorts, that's one of the reasons, the major reasons why they would want a naked short, right? Because it's difficult or impossible to borrow the stock. And this does increase the float because it puts a placeholder, a phantom share, a synthetic share out there, which decreases the price, right? It adds selling pressure. And aka the apes are holding the shares. So why would AMC, or, you know, we've seen it in the past where AMC has been a hard to borrow stock. Now, all this, right, when it's naked short sold, it's indicative, and this is one way that FTDs can occur. The other way would be if there is administrative errors. Okay, so there's a problem with the transaction. Let me bring this up. What is an FTD real quick, right? So failure to deliver refers to not being able to meet one's trading obligations. In the case of buyers, it means not having the cash. In the case of sellers, it means not having the goods or the shares, right? That's why it's indicative of naked short selling, or it could be administrative errors. But when you have ape today, you know, with 43 million apes that were FTDs in one day, I mean, it's really hard to believe that that's all administrative errors. And, you know, the way I always look at it is we're up against some big players, some big money, right? Hedgies, the brokers and the institutions versus us, retail and the apes. So that's the first part I want to talk about. And we can just go through this. I kind of showed you guys this yesterday a little bit, and what I've highlighted. And this was the information that I moved over to that chart. All right, so this is the introduction, and it breaks down naked short selling, right? And when it's hard to borrow, you know, the reason they can naked short, in my opinion, right here, is because they have reasonable belief that the shares can be located and borrowed. It doesn't mean that they have them, but for some reason they're unable to borrow the stock in time for delivery. Further, naked short selling is due to market making. An FTD occurs when the seller of a security does not have the security of the buyer within the standard 3-day settlement period. FTDs can also arise from various processing errors, delaying in obtaining physical certificates, or human error in entering the correct stock symbol. Increases, I talked about this yesterday, so I'm not going to go over that one. And then you get some details. Sorry. Traditional versus naked short selling. So, right, in traditional, they leave the proceeds. Here's the proof of the sale, and a certain percentage of more, right, with the lender as collateral for the borrowed shares. In naked short selling, the seller does not borrow the stock and as a result fails to deliver the stock to the buyer at the settlement date. You know, just want to give you the mechanics and, you know, more insight on what happens. But economically, when you naked short, it's equivalent to borrowing shares at a zero fee, zero rebate equity loan, plus the expected cost of being forced to buy back in the stock and deliver in a process called buying in. And that's what I am thinking, predicting. It's just a prediction. It's not guaranteed. But T+35 is what I'm paying attention to now with the ape shares. Starting from August 24th, and then you have to give it 35 days after that, calendar days. Because naked short sellers do not borrow stock, they can theoretically sell an unlimited volume of stock into the market, bringing the share and driving down a share price, right? That's what that, transfers to. Let's go into this. So the organizations that are involved in clearing and settlement, the own subsidiaries, the Depository Trust and Clearing Corporation provides clearing, settlement, and information services for equities and other securities traded on the U.S. financial markets. That's the NSCC and the DTC, Depository Trust Company. They're subsidiaries and they're all involved, right, with the transactions for stocks. And this is the overall stock market. I'll show you this proof, right? The way the system works, what it's called is called continuous net settlement. And it roughly has 4,000 participants that are regulated by the SEC. Today, these are largely electronic records, although the DTC is also a store of physical certificates. Remember that since we're in this day and age, there's a lot of electronic book entries that the DTC is responsible for transferring stock ownership. And then the DTCC does this by debiting and crediting participants' securities, money, and settlement accounts that are held at the DTCC or at the DTC. Clearing participants include brokers, broker-dealers, banks, insurance, and investment companies, right? So let's move it back over to this other one that I wanted to show you. Yeah, this one. So you have to think of the DTCC as the big dog. They're the clearing house that provide clearing and settlement. Their role is to reduce counterparty risk by guaranteeing obligations will be fulfilled. Centralizes, automates, standardizes clearing and settlement process. Right? And then the subsidiaries, you have the little dogs. The NSCC is basically the middleman. They fulfill clearing roles, serves as central counterparty, guarantees completion from broker to broker equity trades. And then how do they do this? Through multilateral netting. This is basically you're pooling the money and the funds to have less invoices, to have less cash and stocks move around. They're pooling them, basically, multilateral netting. This is not individual orders, all right? So it's through the continuous net settlement and through electronic book entries. And then when we go to the DTC side, they're the ones that fulfill the settlement role, maintains a centralized store of stock ownership records. So that's very interesting to me. And then largely electronic records, but the DTC is a store of physical certificates, electronic bank entries, which are debits and credits. So, your single order is not being filled by a single, way. It's being pulled together, and then they process those orders together. So that's what I got for you on that. Let's jump back to here. And this is the system, right? This is where I'm getting the information from this document. And it just keeps moving around. Hold on. So because the NSCC is the counterparty to each trade, a participant with a short position in a particular stock can be thought of as owing the NSCC the short amount of that stock. And the participant with a long position can be thought of as being owed the long amount of the stock by the NSCC. An algorithm run by the NSCC determines which of the participants with long positions, participants that are owed the stock by the NSCC due to be settled that day, will receive stock. And there's some details about the algorithm. It's in groups of descending order. So you would have the age of the position within a priority group and random numbers within age groups. All right. There's some more information there. Cash credit debit entries are made to participants' money settlement accounts, netted at the end of the day, known as settlement netting. This differs from the exposure netting done by the NSCC. And finally, any net credit balance is transferred to the participant. Any net debit balance is transferred from the participant through the Federal Reserve Money Transfer System, the FedWire. What happens when a fail occurs? If a participant is unable to deliver on their net short position stock owed to the NSCC, the position will be called a fail to deliver on the short, and the short position remains open. When participants fail to deliver stock, the NSCC receives less stock than it owes and consequently may not be able to deliver stock to all the participants with the long position. And remember, apes go long, they buy and they hold, and they go long, right? So that's kind of the relationship that goes on there. And the long positions for which the NSCC is unable to deliver stock remain open. Long positions called fail to receives. This can be thought of as an IOU from the NSCC. Remember, we talked about IOUs, synthetics, placeholders, whatever you want to call them. In my opinion, right, there's probably a lot of people that have IOUs when it comes to APE based on this information that we have about the Ftd's. And critics of the NSCC claim that a potential danger of the system of marking to market. The cash collateral is that the case of fails caused by naked short sellers conducting bear raids as the price of the stock falls. All right. And I'm going to stop here. The next, in the next part 2 video, I will talk about the stock borrow program. But I think I got, most of the details out, and, I'll come out with the next video tomorrow. So if you guys want to tune into that, there will be more information. All right, guys. So catch you guys later.